What is actually holding back home service companies from cash flow, profit, and freedom? What's up, blue collar business owner? Welcome back to the Blue Collar Prosperity Podcast. I'm your host, Paul Maskill, where I focus on helping guide you to have a business that produces consistent, positive cash flow. In doing so, you'll have clarity and confidence that your business is headed in the right direction. Today is another solo show. It is the first Monday of the month, and every first Monday of the month is a solo show where you get to listen to me talk numbers, strategy, business, operations, all the good things to help you achieve the goals you set when you started your business. So the topic of today actually came up a couple weeks ago. Where do most businesses get stuck and why? So we'll get into this in a hot second here, but I was honored to be a part of the New Flat Rates Freedom Builder University. They invited me up to Michigan a couple weeks ago to go speak to some of their business owners, do some workshops on profitability, cash flow, selling your business, all those things. And this is where this topic came from. So that's what we're going to get into is where do most businesses get stuck? The flip side of that first, the most successful businesses are the ones creating consistent positive cash flow. You probably hear me say that all the time because when we simplify business, that's exactly what we need to do. The businesses are predictable, their owners sleep well at night, and it's no longer stressful to run on a day-to-day basis. As a fractional CFO for businesses in the trades, my job is to make sure all of our clients know exactly what they need to do, what levers they need to pull in order to achieve their definition of success, wealth, profit, cash flow, freedom, and all the things we want to do and leverage our business to do so. And what I have learned in the last couple of years really is that for the longest time, all the businesses that I've owned, scaled, and sold, I was operating as the fractional CFO. That's just how my mind works. I remove all the emotion and just simply use numbers to guide the company to where we need it to be. And when we do that, it makes it a lot more simple. It removes the emotion, it removes the ego, and it removes a lot of the variables when really the numbers don't lie. The numbers will tell us the truth as long as we know how to read them and we know what they mean. Unfortunately, most business owners don't know how to read them. They don't know what they mean. And that's no fault of the business owner. That's no fault of you. 99% of business owners didn't start their business because they love numbers. And that's where I come in. I love, meshing and putting those numbers together with the business and the skills that the owner has. And in my opinion, so many businesses out there, especially in the trades, are like 3 feet from gold, if you've heard that thing. We're really like walking this fine line of if we make a couple steps one way, we are super successful. We're achieving the 20% net profit. We have the freedom. We have the cash flow. We have a scaling business that doesn't need us 24/7. We take a couple steps the other way and we're gone. We're in debt. We're on the brink of going out of business. And that's where most home service businesses play, unfortunately, on this fine line. So let's dive into it. Like I said, I was asked by my friends at the New Flat Rate, if you guys have listened to the podcast for a good bit of time since it's been out, Danielle Putnam, she's one of the founders of the New Flat Rate. They help home service companies really build out menu pricing, simplify pricing, and make sure they're charging accordingly. They run a program called Freedom Builders University where they get together every quarter, at least this year. Every quarter, business owners come together at a different location. This time it was in Michigan. We got to tour a plumbing and HVAC company, which was super cool. Got to tour and hang out at a digital marketing company that does work just for companies in the trades. So all in all, great experience. But one of the topics that we worked on, one of the workshops we put together was focused on it is okay to be profitable. For whatever reason, a lot of times in the business world, it is frowned upon when we are actually profitable. We actually almost feel guilty. We feel like since we are such helpers, we love helping people and love solving problems, we almost feel guilty that we're, in our mind, ripping people off if we're actually profitable. Here's the thing. If I asked you, what is the number one purpose of a business? The number one purpose of a business is to make money. Now, the next question that is how much money? That depends on the goals of the business owner. Some business owners might only want to clear $100,000 a year and live an enjoyable life with a couple employees. Nothing wrong with that. Other people might want to scale a company up to 20, 30, 40, 50 million and then exit. Some people might want to play in the middle there. They want to grow it to 10 million before they retire and hand it off to their next generation, to their kids. So that's where I don't want business owners to get caught up. I hate when I see other people chasing this thing that they don't even know why they're chasing it, just because other people are, and they're talking about it on podcasts or social media, and they say, well, I guess I need to do that too. Here's the thing. We have clients that some of them, they want to do $1 million a year in revenue, clear $100,000, $200,000, have a couple employees, and enjoy that life that is ideal for them. Like I said, we have other people who are doing already $10 million in revenue, and they want to take it to $50 million in the next 5 to 6 years. And then we have people in between. They're at $3, $4 million in revenue. They want to get it to 10 million and then reevaluate from there. So that's really the purpose of a business, is to make money. When we say how much money, it depends on what the owner's goals are. But either way, we have to be profitable. And one of the things that frustrates me more than anything, and I've talked about it on previous episodes, is the excuses that we as owners make of why we're not profitable. Here's the thing. In my old office, I had a saying on the wall right above my computer that said, your excuses only sound good to you. And I really do believe that, because we can always justify in our head a reason and we can make sense of it. When we tell other people, they're like, no, you're full of it. But there are 3 common excuses that I hear business owners say more than anything of why they're not profitable. Number 1, they say, well, once I have more revenue, then I'll be profitable. False. Number 2, I'm just reinvesting back into my business. Also false, because usually then I ask them, well, what are you actually doing? And they don't really have a strategy around it. If you have a strategy around it, that's a different story. Number 3, I just don't want to pay taxes. Here's the thing. I'd rather make a whole bunch of money and give some of the government instead of making no money and not give anything to the government. Because if I'm not paying taxes, it means I'm not making money. If I'm not making money, I'm probably pretty stressed. I'm not that happy. I'm not achieving my goals. If I'm super profitable and I'm giving some to the government, I still have plenty left over to do what I really want to do. Now, one of the things that I did for this workshop, I wanted to share with you guys because I thought it was super interesting, is the average home service company is on life support. Most home service companies are one bad month away from going further in debt and getting closer to going out of business. So anytime we have a potential client that reaches out to us and they're interested in working together, they need help with cash flow and profitability and guidance, and they need a fractional CFO, we do what we call is a financial assessment. When we do a financial assessment, we evaluate the last 2 to 3 years of a company, look at what's working for them, what's not working for them, what are some opportunities, what are some red flags, and we get a really good idea of the overall financial health of the company. So I want to share those stats with you today and then dive into a few things of what do we need to do to start fixing this. So out of the most recent 50 companies that we have done financial assessments for, here are some stats. They do $2.9 million in revenue. They have $215,000 in the bank. They have a net profit of 3.79%, $109,000, 3.79%. That is not good. They have less than 1 month of expenses in the bank. Definitely not good. They have 0.92 months of expenses in the bank. So that's, call it 3.5, 4 weeks of money in the bank. And they do not have enough cash and accounts receivable to cover all their liabilities. What does that mean? If they just called it a day today, sold everything, collected all their money, took all the cash that they have, collected all their accounts receivable, they wouldn't have enough money to pay all of their liabilities. So breaking that down even further, I thought this was super interesting. So I broke them into then 3 different groups. We have the under $1 million and under companies. So if they're doing $1 million or under, these people are actually the most profitable, 9.92% net profit. It's actually not terrible for somebody that's probably only been in business a few years. Our target is let's get it to 15, then let's get it to 20, and then if we can, let's get it to 25. So they're on their way there. They have over 3 months of expenses in the bank, 3.12 months of expenses in the bank. What that tells me is they're actually pretty healthy from a cash standpoint. They can withstand shoulder seasons. They can withstand, one of those down years where storms didn't come through or COVID hits and, we don't know what we're going to do. And then we have a big boom and we have a big bust and all that. They're actually pretty financially healthy. And 10% net profit isn't terrible, especially when you start to hear the other numbers that I'm about to share with you. The reason for this is usually they only have a couple of people and they're usually still the one delivering a majority of the service. So they're charging accordingly to, well, what do I need to make on a daily, weekly, monthly basis in order to pay my bills and be, comfortable. So they're doing okay. They probably don't have a pricing formula other than, hey, I need to make whatever it is a day. Say they want to make $100,000 a year, which is what the average is. So now they know I got to make $2,000 a week. They figure out, okay, so now I got to make $400 a day, and they can figure it out. They can do the math. This is what my material is. This is what I need to charge. Super simple, and it shows. Now we get into companies that are $1 million to $4 million. They're not doing very well. So they are doing 1.44% net profit. So that is really not good. Less than 2%, call it 1.5%. So 1.5% net profit on companies $1 to $4 million. They have less than 1 month of expenses in the bank, 0.85 months of expenses in the bank. Now, why is that? So companies that get here, this is where they really start to have to build a team. They have to put leaders in place, probably putting a service manager in place, probably looking to, depending on their business model, maybe it's an install manager, maybe they have an office manager. They're starting to hire other people, and their pricing model isn't made for that. Their efficiencies aren't made for that. They don't have the systems and processes, and they're really struggling of, can I hire this next person? Or when should I hire this next person? The number one way they make a business decision is by looking at their checking account and saying, oh, I have this much money in the bank. I can hire that person, or I can make this investment, or we can move into that new shop. That's a terrible way to make any financial decision. The reason for that is it's a moment in time of a very complex business at that point that you're running. If you're averaging $3 million in revenue, there's a lot of things going on, a lot of moving parts, a lot of transactions, a lot of customers, a lot of vehicles going, coming and going. And if we're just looking at the checking account at, that point in time, I equate it to watching one play of an entire football game and making a decision on who won the game, how'd they play, can we do this, what's our strategy next? Like, oh, we threw an incomplete pass. Well, what's our strategy going to be? Well, we don't really know because we've only watched one play out of an entire game. Unfortunately, that's how most business owners are making business decisions. So where we kind of, when we have, call it 1 month of expenses in the bank, it might seem like a lot of money. Say our monthly, so you can kind of reverse engineer it. If we're a $3 million company and we're at 1% net profit, we know what our expenses are. So, our expenses are 2.7 million. We divide that by 12, call it our monthly expenses. Let's call it just $200,000. So when we look at our bank account and there's $180,000, we think, oh, that's actually not bad. We're a decent company. But when you look at it compared to what you need to operate confidently without being scared, having actual strategies, that's not good. It's less than 1 month of expense in the bank. But we haven't gotten to the point where we realize how much money we actually need to be financially healthy. So we're not stressing payroll, so we can sleep better at night, so we can confidently scale, make better decisions. 1.44% net profit, 0.85 months of expenses in the bank. And again, like I said, this is where most companies get stuck. There's a really good book called Scaling Up. I think it's by Vern Harnish, and he talks about why most companies never get to that 4 or 5 million and above. I think he calls it like Death Valley or the black hole or something. And it's because of that. We're trying to scale. We've got to make investments before the revenue can pay for it. And we just don't have the proper strategy, proper forecasting, cash flow models or anything like that to actually make educated decisions. Instead, it's really just going off our gut and how much money's in the bank account. So those are those people, $1 million to $4 million, 1.44% net profit, 0.85 months of expenses in the bank. Now, the last group, $4 million and up. They're actually more profitable. They make 5.39% net profit. And the reason for that is in order to get over that hump, you have to be able to be somewhat profitable. Otherwise, you'll never get there. You can only use hard work so far. Eventually, you need to have some sort of financial strategy to get over that $4 million mark. Now, with that being said, 5% net profit is not good. At that point, we definitely need to be at the 15% or higher mark. Because going back to what we talked about initially, more revenue is not going to solve your problems. If you are not profitable, adding more revenue is just going to make your problems bigger. So $4 million and up, they figured it out. They probably have enough managers in place, leaders in place. They've got enough technicians out there. Still not super financially healthy. And then from a cash standpoint, this is actually kind of surprising. They actually are the worst performing from how much cash do we have in the bank compared to our expenses. They have 0.76 months of expenses in the bank at over $4 million. I think the average size of these companies, of all the ones we looked at, I think they're doing around $7 million. So 0.76 months, that's basically 3 weeks. You have a bad couple weeks and you're going further into debt. So even though they're more profitable than the $1 to $4 million companies, they have less cash flow. And again, part of that is just perception, part of it's bad strategy. But when you're doing $7 million, you might have a couple $100,000 in the bank and you feel like that's a lot, but it's really not, because that money can go away quickly. Now we're drawing on our line of credit. We're going to our credit cards. We're asking our vendors for more favorable terms. And it's really just not that fun to run those type of businesses. It would be awesome to run a boring business that makes 15 to 20% net profit. And we don't have to worry about a lot of things. Bills are on auto pay, auto debit. We don't have to worry about payroll. We can process it the day our payroll processor asks us to. We don't have to wait till the last minute. Life is good. Now, one of the analogies I like to think of is it's time to start acting like a shareholder of your company. So if you think about it, if you've ever thought about, or if you've ever bought stocks, we buy stocks in company, which is we're buying ownership in company of companies that are profitable and growing. Meaning if we buy it today, we want it to be more valuable in the future, and we want it to produce consistent profit so we can either get dividends or increase value or both. However, we do not treat our own business like we are the shareholder of it. However, flip side of that, you've taken the risk to be a business owner. You now own most likely, even if you have partners, you and your partners, but a lot of times it's just you and your spouse. You own 100% of the shares of a company that is not doing well, and a majority of your wealth plan is in that business when you sell it someday. Here's the thing. The average company is not sellable. It is not sellable. If it is, it's not going to get nearly what you want based on the blood, sweat, tears, and work you've put into it. So how do we turn this thing into a profitable, valuable business? Cash flow is the number one reason businesses fail. They run out of money. They've got too much debt. They call it a day. It's just not working out. Like I said, using those numbers, under $1 million, it's working out. We keep going, but then eventually it becomes a massive problem. So you can no longer make financial decisions just by looking at your checking account. Say it again. You can no longer make financial decisions by just looking at your checking account. We need to start using numbers to make financial decisions, and in turn, that'll help us make better operational decisions. Every single business owner needs to have a dashboard. They need to have the KPIs that are important to them that they're tracking so they know if they are healthy or not. If they know they're not healthy, then they can dive into it. You can figure out what's actually causing this to be an issue. So what are some of those things? Really, even just simplifying it as much as possible to look at operational KPIs, which will then flow into your financial KPIs. But a lot of times business owners, financial measurements, margins, all that gets super confusing, but operationally, it makes it a little bit easier to digest. So a couple things that I would like everybody to be at. Net profit of 15 to 20%. What does that mean? Look at your P&L. How much money is at the bottom line divided by how much money came in. That's your net profit. We want it to be at least 15%, going to 20, on its way to 25. How much cash do we need to have in the bank? In my opinion, a very healthy business has 3 to 6 months of cash in the bank. That range will depend on how much debt you actually have. If you have a lot of debt on your business, you're going to need more cash. If you have no debt, if you're a debt-free business, 3 months historically is plenty for your business. Another one, revenue per employee. This is not revenue per technician, revenue per employee. So if you have 5 technicians and 3 office people, that's 8 people. Revenue per employee total, in my opinion, depending on your industry, depending on your trade, minimum of $200,000 per employee, all the way up to $350,000 per employee. The reason I give you that range is most people aren't at 200, so we don't want to focus on going from 150 to 350. Let's go from 150 to 175, 175 to 200, on our way to that $300,000, $350,000 mark. Revenue per employee, super important. Just super easy to know how financially healthy your business is. Next thing, call booking rate. Out of all the people that reach out to you to book service, how many actually get on the schedule? We need that to be at least at 85%. Super simple to figure out how many calls, how many inquiries came in versus how many of those actually got scheduled. If your CRM doesn't do it, I would encourage you to have a VA or somebody in your office do it. Next thing, field closing rate. This is very variable, super dependent on your type of business. Most companies we see on a blended, the target is going to be around 65%. That means if you give out 100 quotes, 65 of them say yes. Now, breaking that down, if you're doing a lot of install work, big ticket stuff, it's probably less than 65%. If you're doing all service work, repair work, especially call it heating and air, plumbing and electrical, if your client calls you and something's not working, that needs to be like 80, 90, as close to 100% as possible, to be honest, because otherwise you're leaving that house and they still have the same problem that they had when they called you. So, and then if you look at something like maintenance, if you have maintenance agreements, especially if you're in HVAC, how many of those, regular visits do we turn into actual revenue? That's usually a little bit lower. I know, most companies shoot for around 40%. If you can get above that, that's awesome. And it really depends on the quality of technicians and the quality of training. But blend that all together, depending on the business, let's make sure we're at least at 65%. And then another one I like to look at, because it's super easy to look at, you don't need to look at any financials, is how many field staff do you have compared to how many office staff? So basically, how many people are out in the field driving revenue versus how many are in the office supporting it? We need that ratio to be at least 2-to-1. So if you have, call it 10 technicians out in the field, technicians, installers out in the field, we should have no more than 5 people in the office. 2-to-1. As we get better, as we get bigger, as we get more efficient, probably trending 2.5, 3, even higher. I've seen companies that actually have, they're closer to like 4-to-1, which is impressive. So yeah, those are some simple ratios. Net profit, 15 to 20%. Cash in the bank, 3 to 6 months, depending on your debt load. Revenue per employee, $200,000 to $350,000 per employee. Call booking rate, 85%. Field closing rate, super dependent on your business. Let's shoot for 65%. And then a field staff to office staff minimum ratio of 2-to-1. If you are not achieving these or most of these right now, here's the thing. More revenue will not solve your problem. It'll simply make the problem bigger because there's something systemically wrong right now with your business. So we need to fix that before we get more of bad stuff. And instead, we'll go get more of good stuff once we fix it. So that's all we got today, guys. I know this is a longer episode than usual, but I thought it was super valuable, super insightful information that I wanted to share with you. Again, that I shared with all the people at the New Flat Rate and their Freedom Builder University a couple weeks ago, doing a workshop for them on cash flow, profitability, selling your business, all that good stuff. Now, the key to all this is just get started. If this episode was super overwhelming, just focus on one thing. Start building out your KPI dashboard one at a time. What is it you want to track? Is it net profit? Is it call booking rate? Is it field closing rate? Is it cash in the bank? Whatever it is, just start tracking something because something is better than nothing. Momentum is a powerful thing. Once we get started, then we can continue to build that habit and make it bigger and make it more valuable. What I see sometimes is people try to go 0 to 60, it becomes super overwhelming, so they just call it a day. Just like someone that hasn't gone to the gym in years and they say they want to get back in shape. In the book Atomic Habits, this is kind of a tangent, but in the book Atomic Habits, he talks about the importance of building the habit first and then going for those results. So I think he talks about going to a gym. If you haven't gone to the gym in a long time and you want to start, he had his people like literally drive to the gym, walk through the door and walk back out and just build that routine. And then they start working out. Because otherwise, if you try and go from nothing, like most people do January 1st, and then it's like, I'm going all in and I'm not eating any sugar and I'm working out 7 times a week and by January 15th. They're done. So the key to all this, just get started, start building that momentum. If you need help with any of this, go to thebluecollaradvisors.com. That is our website. There you have several options, 2 main ones. Book a call with me. We can jump on. We can do one of those financial assessments that I just talked about. They're totally free. It allows the owner to get a better insight and allows us to get a better insight to make sure it's a good fit. So that is what the financial assessment is all about. So you can go there and book that. And you can also tackle the number one issue I see with businesses, which is being priced properly. So there is a download worksheet there. Super simple 1-page Excel document, has a video walkthrough, has a PDF walkthrough, and is super valuable to see if you're actually priced properly, which will probably solve a lot of these problems. That's all I got. Take action, make it happen, get 1% better every day, and you'll be 37 times better by the end of the year.